Good evening and welcome to this session of our month-long series, Making Sense of Finance. We hope that you've enjoyed the session so far, and we look forward to having you at some of our other upcoming events throughout the rest of this month. My name is Katrina Boyer. I'm the Investor Education Coordinator with the Pennsylvania Department of Banking and Securities. Just so that you are aware, we are recording this session, so I ask that you put your questions in the chat box, and Ms. Zuge will answer them at the end of the session once we've stopped the formal recording. On behalf of the Pennsylvania Military Finance Alliance and the Department of Banking and Securities, we welcome you to this session of Investing 201, and we're thrilled to have you here. You will be receiving a survey that will pop up as soon as you exit today's event. If you would please be so kind to complete that and submit it, that goes a long way in helping us to make for better events and continue our work with virtual webinars. If you have any questions, you are welcome to contact me once I send you a PDF of today's session and any other handouts that Ms. Zuge has. So without anything further, Holly, take her away.
Thank you very much, Katrina, and welcome everyone, and thank you for being here. We're here in Harrisburg, and it is a lovely sunny evening, and it's dinner time, so we really appreciate you taking time out of your busy schedule and your personal time to be with us. And since it is Military Appreciation Month, if you have served or are serving, we definitely appreciate your service. So we're talking about Investing 201, sort of a continuation and elaboration, is that the word I'm looking for, on our Investing 101 saving and investing sessions that Katrina had done for the events. So today we are going to talk more about rules for building assets, stocks, bonds, and mutual funds, risk versus reward, investing strategies, and accessible investing. So I have a question for you, and if you would think about this and share in the chat box, what comes to mind when you hear the words invest, investing, or investment? What comes to mind? If you would please share, you'd like to know. Wealthy people. And we're going to talk a little bit more about that too. Anything else? How about emotions?
Holly, there are some that are coming in privately. So you've got stocks and bonds.
Okay, sorry, I didn't see that. Okay.
It's okay. Volatile markets, fiduciary, stocks. So there's quite a bit of feedback here, which is great.
Oh, terrific. Yeah, I can't see that for some reason. And
it's coming in to host rather than
okay, then everyone. Okay, great, thank you, and thank you for sharing. Yeah, there's a lot of stuff that comes to mind, and hopefully today we'll be able to relax some if you have any concerns and clarify a few things. But it's really kind of, for me, it was always like kind of fearful. It sounds big and fancy, and it sounds like I can't do this because I don't have a lot of money. And it's just really intimidating. So again, I hope today we can clarify some of your concerns and put you on your way to investing. All right. So there is a difference between saving and investing, and I just want to make a point of this. Saving is just setting cash aside. And I don't want to say for no purpose, but when you save some money, you want to make sure that it's there. You want to make sure that it's safe. $1 in goes $1 out. You might earn a little interest on this. It's liquid, meaning it's turned into cash easily, and liquid is one of our fancy terms that we'll mention a couple of times during this presentation. But that's what saving is. It's just stashing your cash, putting it aside. Whereas investing is taking that cash to buy or build assets for some kind of income or gain in the future. Again, it's for the future. Investing, buying those assets are less liquid, which means it's harder to turn them into cash. There may be some risks involved, may lose value, nothing's guaranteed. And again, for the future, you buy these investments for a cash earnings or to sell for a profit. So again, that's the difference between saving and investing. So think about where your cash comes from right now. Right now, for most of us, it's working. And I bet if I asked, thumbs up, how many of you work hard for your money? I'd have like everyone doing their two hands up. We do work hard for our money. We're earning our money. But what happens in the future if you stop working? Where does your cash come from? Well, it comes from the things that you own. It comes from our ownership. Our money is working hard for us. So we'll clarify that in just a little bit. But the buzz phrase of the day is building assets or buying assets, something of value. Okay, as we move on. So a couple of rules for building assets, and I know that this was that a couple of these were addressed earlier in earlier presentations, but the first is start early. If you haven't started saving or investing now, the best time to do it is today. You can't worry about what you didn't do in the past, but start today. And if you are young or you have young people in your family, encourage them to start today. Stay invested, which means take advantage of compound interest, which means any interest or growth that you earn starts to work and earn interest and growth on top of that. And the third one, which we're really going to focus on today, is diversifying. What kind of assets to buy? We don't want to have all of our eggs in one basket, so we want to diversify. And the types of assets that we're talking about, there are financial assets, stocks, bonds, cash, of course. There's real property, your home or land or rental property, small business. I think that's the ultimate asset to have. Lots of risk associated with that, but small business is definitely an asset. Your bling, your personal items, your cars, all of these things are assets or things of value. And it's important to have a variety of these things. And the reason is, first, the question is, what is the biggest asset of most Americans? And Katrina, if you have any answers in the chat that I can't see. We've got home ownership.
Casey says house.
House, right? Yeah, that's the biggest asset that most people have, is their house. And having a home, owning a home is the American dream, and it is a foundation for building wealth in the future. And wealth means different things to different people, but it's, that's one of the assets that we have. But it's important to think about. And I remember, and this is not my house, but when I bought my house, there is no money closet anywhere. I looked, I searched. There's no money closet. So it's a great asset, but it's not liquid. You can't get cash out of it quickly. And there are conditions on that. So what happens if you don't have a job? And certainly COVID-19 has shown us, lack of jobs this past year has done some damage to many people's lives. So if you have no job, how do you pay for groceries? How do you make that mortgage payment or the rent payment? How do you take care of your kids, send them to daycare? And how do you make the car payments? Things like that, if you don't have other things to fall back on. So not just a house, but cash reserve, having stocks, bonds, mutual funds, other financial assets that you can use to supplement the missing income. So that's what we're going to focus on. We're going to focus on those financial assets. And we love it when the value goes up. The stock market hit an all-time high of 35,000, the Dow Industrials, woohoo, just recently, but we don't like it when it goes down. And I did check the stock market today and it was down 700 points. So, but there are a lot of questions that come along with these financial assets. And again, all of the feelings that you were sharing before. So let's take the fear out of stock. Now, stock is simply, and I say it simply, a share of a company. So how do they actually work? So if I'm an investor and I have cash and I want to make that cash work, well, here's a company, the burger joint. Company needs cash to do some research and put out their product, a wonderful hamburger. So what happens? They say, okay, well, I'm going to give you my cash, and the burger joint gives me a share of that company. Now, it's not like a share of a fryer. I can't go in and get a chair or, a free soda or anything like that. It's really, it's a paper share, if you will. It just represents one portion of that company. It's kind of like magic. Not really, but kind of. So what happens then? So let's say Burger Joint does its research and has this wonderful burger. And I know it's dinner time and I do apologize for this. Wonderful burger. Oh, it's delicious. And there are 20 calories. That's it. They did the research, 20 calories. This is it, people, 20 calories. Wow. We have a lot of people, a lot of consumers love this burger. Hey, 20, only 20 calories. I'll have like 10 of them. So what happens is the burger joint sells a lot of the burgers. They are able to share some of that profit with me as the stockholder. They pay a dividend. So I'm getting to share in that profit. And because the company is paying that part of that dividend, other investors say, me too, I want to be part of that. I want a share of that stock. I want a share of that company because I want to join in the profit. Well, if I want to sell my shares to them, I'm going to, the value of my stock will increase because of the profitability of the burger joint, and I can sell it for a profit. Oops, oh, news alert. Well, the burger was fake. It's really 2,000 calories, not 20 calories. We're just kind of off by 100, 100-fold. And what happens is the company is not going to make sell any of the burgers. They're not going to make a profit. They're not going to be able to share. There's nothing to share, so there's no dividend. And other investors won't want a part of, an unprofitable, company. So if I want to get rid of the stock and turn it into cash, I'm going to have to sell it for a loss. So this is a general, this is how stocks work. When you are investing in a stock, you are investing in the company and you're investing in the business and what that company actually does and what those products or service that company makes. All right, so that's a stock. Now, what is a bond? Well, a bond is an IOU, and you as the bond buyer are the lender. So this is how it works. So I'm an investor and I have cash, I want to make it work. Now, the city needs money to build a museum because they found a live dinosaur. This is real, people. It's real. They found that dinosaur. This is so exciting. So I said, sure, I'm going to give you my money. I'm going to buy a bond and you're going to give me that IOU. You promise to pay me back in the future with interest. That's what a bond is. You're lending money and that organization, company, government is going to pay you back with interest in full in a future date. All right. So let's say, the city goes ahead and builds a museum, and people are so excited about this live dinosaur at the museum. So they come to the museum, they bring their family, they bring their friends, they come multiple times, and the museum makes lots of money. They're able to pay interest on my bond, and they're able to give me my principal back. So they're repaying that loan. Cool. Now the city says, well, we have another project. Will you like to invest in this project? Would you like to buy a bond for this project? So of course I would, because the city has a good history of borrowing money and paying it back to me, the bondholder. So I would say, sure. But because of that good history of paying back, the city will actually not pay as much interest. Doesn't this sound like our personal credit? If you pay back, if you have a good credit history, you will more likely have lower interest rates in the future. Oh, wait a minute. Newsflash, newsflash. Oh, the dinosaur was fake. Sorry, my bad. Nobody's going to want to go to see the museum. There is no interest to pay because there's no admission fees. And the city defaults on the loan, which means they don't pay me back what I lent them. So the city says, well, okay, that was a mistake, my bad, but we have another project. Would you please really, really like to buy a bond from us now? Well, no, I wouldn't want to do that. But to entice me to buy a bond, they would have to pay higher interest rates. So again, a bond is an IOU that you are lending money to either a company, municipality, like a city, a state, or even the federal government, which is US savings bonds and US Treasury bonds and notes and things like that. So they are borrowing money from us. All right, so now let's take a look at mutual funds. What are mutual funds? Well, mutual funds simply is a pooling of money. So I'm an investor. I have two other friends that are investors. We have money, we have cash, we want to make it work. but we don't want to pick out the stocks. We don't want to pick out the bonds because that's not our job. That's that's for the money manager. Money managers do that. They can invest cash for us. So this is what happens. We pool our money, give it to a money manager, and the money manager gives us a share, puts it in a bucket, I should say, gives us a share of that bucket. Okay, so what happens then? Well, the money manager takes the cash, buys stocks or bonds or whatever, and they have to tell us, and we'll go through that in a little bit later. And again, buys the stocks and bonds. Now, of course, if the stocks perform well, if the bonds perform well, there's going to be interest and dividends to pay us as the investors, and the value of that bucket goes up because the value of the investments, the assets inside increase. So if we wanted to, cash out, we could sell our share of the bucket for a profit. Now, of course, just the opposite is true, as we saw before. If the bonds are not paid back, if the stocks are not profitable, there are no interest or dividends to be paid. And of course, if we wanted to cash out, we would have to sell our share of the bucket for a loss. So again, this is the general concept: stocks, bonds, and mutual funds. I do realize it's sort of oversimplification, but just to make it more easily understood. There are other financial assets that we're not going to talk about because this is getting into more risky investing. And, I think that if you're just beginning to invest, it's good to start out on a more conservative level and not go to again, more risky products. So these are derivatives, which you might hear stock options, or the futures market, which they're betting on. If you have a stock option, you have an option to buy a stock or option to sell a stock. So it's really, you're trying to gamble on what the value of that stock is in the future. Similarly, for futures, which are commodities, you're betting on the price of those items like corn and wheat and oil and things like that. So it's betting on the price in the future. And then there are foreign currencies. You can invest in foreign currency, and that you make a profit based on the exchange rate against the dollar. Again, that's that's beyond me, way beyond me. But that's an opportunity to make money, as well as gold. That's another area of other financial assets, if you will. Okay, so back to mutual funds for just a moment. Mutual funds, the money manager has to tell you what they're investing your money in. And there are different types of mutual funds and their investments. So mutual funds can be described by the type of assets that are inside that bucket. So they might be stock, it might be a stock mutual fund, it might be a bond mutual fund. There might be those options and futures. Okay, that might be a little more high risk. They might invest in real estate as well. Then index funds. Now these funds are investing in standard, I want to say the indexes. So we have the Dow Industrial Index, we have the S&P 500. This is simply a mixture of assets that are determined by, like S&P, the Standard & Poor's company determines the top 500 businesses and industries in this country that represent our economy. So you can invest, when you do the index, you invest in all 500 of those companies. So that's really a way to help lessen the risk of just having one type of stock or one type of bond. It's a different way to diversify within that type of asset. Then we have target date mutual funds. So these are based on when you're going to need the money. And we see this a lot in 401k programs, retirement savings programs. So if your target retirement date is 2030, the money manager is going to design the mix of assets. Right now, they can be a little more aggressive because that's not until your retirement is not until 9 years. But as you get closer to that target date, the investments become more conservative. And then there are sector funds, which focuses on a certain company or certain companies in an industry or a particular sector of our economy. So you can have financial mutual funds, you can have technology funds, you can have healthcare funds, et cetera, energy funds. et cetera, et cetera. So the sector funds, and that can be risky based on, what that market is doing. I mean, we're seeing now with oil and gas, that's an unknown right now of where we're going to go with those types of products and using those types of products. So that may be, more risky. And then location, there are there are mutual funds that are based on, are they in the United States? Are they outside of the United States? Are they in Europe? Are they in Asia? So again, particular part of the world can be, found in a certain mutual fund. Again, all of this is disclosed to you prior to you making that investment, but just so you have an understanding of what these different types of funds actually mean. Okay, so my question is, how do I choose what investments are right for me? That's the $10,000 question, right? And the answer is not eeny, meeny, miny, mo. It's really nice, but it's not probably a good way to choose. We really want to think about what the objective is of buying that asset or making that investment. We want to look at the time frame, and we also want to look at the risk involved. So these are the three factors that really help us make those decisions. So let's look at objectives. What is the objective of this asset? So do you expect the asset to have a guaranteed value like cash, safe principal? Do you want cash payments in the future, which means you could invest in bonds, which they pay interest, or stocks that could pay dividends? So that's cash payment. Is your objective to have that asset grow in value? So, and you can sell it for a profit. Very common are homes. We want them to grow in value so that if we do have to sell them, or when we do sell them, we can do that as a profit. So that's what growth means. And then growth in income means a little bit of both, increase in value and a little bit of cash. And then there's speculation, which means, hey, it's a gamble. If you lose it all, you're not going to worry about it. I don't know too many people who do that, but again, that is an objective of investing. Now, time frame, short term, medium term, and long term. Obviously, if you need your cash within, a year's period of time, you're not going to go buy stocks. You're not going to go buy a house, because you're not going to have access to that very easily, or the unknown value in the future. So you have to, a savings account or a certificate of deposit might be more appropriate. Medium term, 1 to 4 years. Long term, 5 years plus. So obviously, if you're purchasing a home, that's a long term investment. So what is your time frame? Then we look at risk, and here are a couple of different kinds of risk. We have market risk, which is simply follow the leader. And a market is simply a collective group of assets. So that might be the stock market, so all of the stocks. It might be the housing market. For example, what happened in 2008, 2009 when the housing market tanked? Well, if you owned a home at that period of time, the value of your property probably went down as well, because you're following the leader. You're following what happens to all of the other same type of assets. Then we have company risk, or one bad apple. I might be dating myself now, but do you remember Enron? Enron was an energy company where the CEO and his team, they were cooking the books, and which meant that their numbers that they were reporting were not real, and the company ended up going belly up. Now, we hope that companies have board of directors that will guide and make sure these things don't happen, but they can happen, as we saw with Enron. Liquidity risk, get cash now, and how quickly you can turn something into cash. That is a risk if you buy a home. Remember, there's no cash closet. How are you going to get cash out of your home? You either sell your home or take out a home equity loan, but then that means you have to qualify for that and you have to pay it back, and it's going to be expensive. So liquidity risk is get cash now, is the risk for that. And we think about a savings account, that's very low liquidity risk, because you can just, you can go to the ATM machine and get cash out of a savings or a checking account. Then we have interest rate risk. So it's the price of money. So if interest rates are on the rise, that's going to mean that, number one, we are paying more for credit. Or if interest rates rise, for example, if you have a bond that is paying, oh, make it the math easy, 5%. It's paying 5%, and the interest rates rise, and the new bonds that are being issued at 7%. Well, that's a 2% difference that you are losing out on. So that's an interest rate risk. On the other hand, if interest rates are dropping, that means it's good for you because you're earning more than new people buying bonds. So the price of money, diversity, all eggs in one basket. We talked about that. Longevity, this is really interesting for thinking about retirement savings. Will you be outliving your money? So it's really important when you're thinking about investment considerations, what's going to help you keep up with inflation and not outlive or not, run out before the end of your life. And then inflation risk. Dollars become worth less and less due to inflation until they become worthless. Okay, hopefully not. But again, how much did a loaf of bread cost, back in 1980? Okay, again, dating myself. 75 cents. How much does that loaf of bread cost today? $3? So it's the same loaf of bread. Actually, it's probably smaller, but that's inflation. Our dollars buy fewer and fewer products as the years go by. So why do we take these risks? Well, let's say you had $100 in 1990. Today, that $100, it would take $198 to buy the same amount of products. So that's inflation. So that's the value of inflation. If you took that $100 and bought a certificate of deposit that renewed every 6 months, today you would have $245. So that's good. So that means you're beating inflation, but just a little bit. But that's okay. You're keeping up with inflation. If you invested that $100 in a T-bond, which renews every 10 years, again, a T-bond is the US Treasury, you would have almost $500 today. Much, much better. But if you invested in the S&P Standard & Poor's 500 index, again, which represents the US economy, today you would have over $2,100. And that's why we take risk. Now, is that a straight line from 30 years ago? Absolutely not. Again, what happened in 2000 with the tech bubble, what happened in 2008, certainly with COVID, just the indexes, the stock market does not go up, in a straight line. And you have to be aware that there is a risk for that fluctuation. And it can be, 10%, it could be 20%, it could be, 40% as a downturn. So you just have to be careful about trying to time the market and try to, buy low, sell high. We all want to do that, but nobody knows what the market is going to do. So you have to try to make the best decisions you can with regards to that. Here's just an outline of risk versus reward in certain types of assets. Obviously, if you have an insured savings, the reward is very low, but the risk is very low. And as you go up the pyramid, bonds are more risky depending on the profitability of the organization and what they're doing with it. Again, stocks more risky based on how profitable the company is. And small business, I mentioned before, that's the ultimate asset, but it's also the most risky because everything, your livelihood relies on that small business, income, benefits, retirement savings. So that's, again, just a guide for risk reward. So how do we put this all together? There are some descriptions that we can use that I'm going to share with you if I can get this here. So if your investment strategy, if you're conservative, capital preservation, which is a fancy word for saying you want a guarantee. You want it stable, you want it guaranteed. And here are some guidelines. If you want the money now, this is a great strategy to have. The risk is low, reward is low. And here are some examples of assets for capital preservation: the insured savings, certificates of deposit, money market deposit accounts, and then money market mutual funds. So income, if your strategy is an income strategy, it could be conservative to moderate, depending on the riskiness of who you're lending your money to. The objective, again, is regular cash payments, interest or dividends. Time frame can be short to long. Risk can be low to medium, again, depending on who you're lending your money to. The reward, low to medium. And here are some examples: US Treasury bills, bonds, notes. municipal bonds, which are referred to as muni bonds, corporate bonds, and then bond mutual funds. So if your objective, your strategy is a growth strategy, it could be moderate to aggressive. Again, objective, worth more than you paid for it. Time frame, medium to long term. Risk, medium to high. Reward can be medium to high as well. And here are some examples: stocks, stock mutual funds, and real estate. Growth and income, a little bit of both. That's your strategy. It's moderate. You want it in balance. Some worth more, some cash payments. Again, time frame, medium to long term. Risk, medium to high. Reward, medium. And then examples: stocks and bonds, balanced mutual funds, and real estate, preferably rental real estate for those income payments. Value investing, good stuff cheap, the value meal. So this is like buying on a discount. If you have undervalued or, out of favor stocks or overlooked industries, again, time frame, medium to long term, risk, depending on the issuer or the company. Reward can be low to high, it depends. Example, some depressed stocks or sectors, non-investment grade bonds, value mutual funds, and flipping real estate. You want to buy that real estate on the download and fix it up and sell it for a profit. So that's value. And then there's one final strategy, hedging, which is an aggressive strategy. This is where you're taking both sides of the equation. You're trying to limit your losses. And the time frame could be short or long. Risk could be minimum to high. Reward low to high. We talked about stock options, where you're betting on the price, betting on the future price of a stock, or you're betting on the future price of a commodity, soybeans and wheat and oil and things like that. So these are some options to try to lower your loss. But again, there's risk in doing that as well. So let's talk about capitalization. People often say, what is market cap? It's a fancy phrase for the stock price times the outstanding shares a company has. What does that mean? Wow. Stock price times outstanding shares. That's what market capitalization is. And common market caps are large cap, medium, and small cap. And I do apologize that I didn't put the actual numbers there. And I don't want to misquote the large, medium, and small cap, so I'm not even going to mention that. But just know that there are basically three different categories that we often hear about. Now, this correlates to, as this shows here, age, risk, and objective of the company. Large caps are usually well-established companies like McDonald's, IBM, Home Depot, Microsoft. I'm just throwing that out there. That's not any sort of investment advice. But these are well-established companies. Small caps are newer companies. So these are the Apples and the Microsofts of 30, 40 years ago. They want to become large cap stock. And there's risk to that because they don't have established businesses. And again, it determines where the stock can be traded. Small caps usually are not found trading on the New York Stock Exchange. There is the NASDAQ, which is another place. It's actually all electronic now, but is another place where the small cap stocks can trade. All right, so a little bit about market cap. So here's an interesting chart. It is the Callan periodic table of investment returns. So if you want to know, what is the best investment? Well, how about let's look at this historically, because remember, we can't predict the future. But here's an interesting, so it's 2000, this chart says 2001 to 2020. And the top of the chart, the top row, shows the highest performing set of assets or group of assets. And of course, the lower is the bottom. And these are only the top 10 for each year. There are many other asset classes, but these are only the top 10 that are being reported. So again, at the top, that's where you find the most gain. At the bottom, you find the most loss for that year among the top 10. So let's look at 2019 and 2020. So 2019, the large cap stocks, that was the highest performing area of almost 31.5%. versus the lowest performing in the top 10 was cash. So making 2.2% on your cash. Now in 2020, small caps, the small cap stocks were the best performers. And that's almost 20% on the upside. Now, real estate took a dump. And the reason why, these are real estate investments, not the housing market per se. This is like commercial real estate. So if you have, what happened in 2020? We had COVID-19. Nobody was going to malls. No one was buying things, in brick and mortar places. So the businesses couldn't afford to pay their rent, which means the value of the investor in that or the owner of that property wasn't making any money. So again, if you're interested in this is the Callum periodic table of investments. You can Google them, but it's kind of an interesting looking at what's performing or what has performed in what year. And this is certainly not any endorsement or constitute any sort of investment advice in any manner. Just something interesting to look at if you are so inclined. So who can invest? Everyone. Everybody can invest. All these people, all of us can invest. Well, you might be saying to yourself, well, I'm not rich. How can I invest if I don't have a lot of money? Well, that's where it really realizing how accessible investing actually is. So let's talk about that accessibility. First and foremost, if you have access to an employer retirement savings plan, you can become an investor. Typical plans have a variety of mutual funds to choose from, and that could be aggressive mutual funds, that could be very conservative mutual funds, but that's the first place that you can do this. And typically there are very low minimum investing amounts. It might be $10 a paycheck, $10 a paycheck, and you can become an investor. How accessible is that? Then there are 529 college savings plans. These plans are either prepaying tuition or they have an investing option, and the minimum amount to open up a 529 college savings plan is $10. You can put $10 in a month to save for your children's education, and you have those investing options. To a sister product to that is called an ABLE account, and this is for people with disabilities that help them achieve a better life experience. And again, there are investing options to that. And the 529 and ABLE accounts are managed by the Pennsylvania Treasury Department. There are dividend reinvestment plans. This is where you can actually go directly to the company. You can buy one share, and then you can be put on a plan where every time a dividend is paid, you buy more shares of the stock. You can also buy shares of the stock directly on a monthly plan. It might be $25 a month getting into this individual stock. It might be $50 a month. But again, very low amounts getting into the investment, the investing realm. What am I trying to say? There are online trading platforms that you can do with very little. Some are $100 to open the account. Some are a little bit more, and then you pay per trade in the various stocks. And these, you have to kind of do your homework on the stocks or the bonds that you're investing in on these online platforms. But again, the idea is accessibility. You can go to mutual fund companies direct, and these are places like Fidelity, Vanguard, T. Rowe Price, Charles Schwab has their menu of mutual funds. So you can go to them directly. This takes a little bit more, usually $1,000 to open up a regular account, might be $500 to open up an IRA. But again, it's getting that higher minimum deposit. But again, these are places where you can go. And then having a traditional brokerage firm. Again, it depends on what you're investing in and how much they require to open an account. So it kind of down the list of the more it takes to get involved in investing. Okay. All right, and just a mention of retirement plans. The Garland Murray of the PA National Guard is going to have a session on the 25th of May during this series, and he'll be talking about retirement plans, the blended plan, blended retirement, and the TSP. So you can get the links to register on the Department of Banking and Securities website, dobs.pa.gov. So if you're interested, again, more in that retirement planning piece, definitely join us on the 25th. Okay, last portion as we're coming into the home stretch, understanding financial services, the companies and the products that they offer. So banks and credit unions, obviously cash management, checking, savings, and borrowing products, loans, credit cards, things like that. Brokerage firms offer stocks, bonds, mutual fund options, and again, some of the more aggressive investments, financial assets. Insurance companies. Now you may say, what does that have to do with investing or anything like that? Well, life insurance policies and some annuity products actually invest in the stock market, they invest in the bond market, they offer mutual funds inside those policies that you can choose from to try to beat your investment returns. Investment companies, okay, so these are, we talked about before, the mutual fund companies, and some offer different other managed accounts. If you have a high net worth client, they might go to an investment company and have a money manager, a private money manager, manage their money. Excuse me. And last but not least, we have financial planning organizations that may offer financial planning services or financial plans. But the caution is always understand if they are offering any type of financial product, whether that is a stock, bond, mutual fund, or life insurance, or anything else, they must be licensed to do so. So the professionals themselves, tellers, obviously are banks and credit unions, process the cash transactions. Loan officers are the ones that actually sell loans from either the institution they represent, or they could be a broker shopping around to different lenders for you. A broker, we're talking about a stockbroker. They buy and sell stocks and bonds through the exchanges. Again, we have an electronic exchange, we have the New York Stock Exchange, and that's where the actual trading happens. They match buyers and sellers essentially. Investment advisors, meaning they get paid for giving investment advice. Now, you may get information or suggestions through brokers or through, a financial planner, but an investment advisor, again, gets paid for that advice. And the brokers aren't necessarily getting paid for that, but they may suggest, so consider, in making this investment, and consider that. They're not actually giving you that advice, or an investment advisor says, well, this is where we're going to invest your money, kind of thing. And then financial planners. Financial planners, this is a general term. Anyone can call themselves a financial planner. There is no licensure or designation for a financial planner in general. They may sell products and services, but again, make sure that they have license under the underlying, if they're selling insurance, they have to be licensed by the insurance department, et cetera, et cetera. Now, there are designations for financial planners. There are different designations. A certified financial planner is, has done coursework, has a degree, passed a comprehensive exam, has to have continuing education. So there are different levels of certifications. And we're going to talk about FINRA on this, and we are not. The Financial Industry Regulatory Authority, or FINRA, FINRA.org. And maybe if you can put that in the chat, maybe Katrina, please, that would be great. They are a great website to check on any of those initials behind somebody's name of a financial professional. So I encourage you to go and look at that, and I'll show what is required of that. If there's an exam, if there's coursework, degrees, continuing education, and there are a variety of certifications, and there are a lot that are really easy to get, meaning you can read a booklet, take an open book test, pay a fee, and now you're certified, versus, another more aggressive program to really make sure that whether it's a financial planner or advisor, really has the knowledge and skill to do a good service for you. Whew, wow, we made it just in time for questions and answers. But remember, today we talked briefly about the rules of building assets, stocks, bonds, and mutual funds, risk versus reward, investing strategies, and accessible investing. And again, there is so much information out there about investing. I would encourage you to take advantage of the resources that the Department of Banking and Securities offers. All about how many, like 60 plus brochures, Katrina, that you have on your website. Really great information about in more detail of everything that we talked about today. Also, the FINRA website as well has some great information on investing. And never be afraid to ask questions. I think that's the big thing. You know, there are so many questions, and you know, this is not something that we learn in school, or you know, that's intuitive in any manner. So don't be afraid to ask questions, and don't be afraid to walk away if something doesn't feel right. If you feel that the person you're working with doesn't have your best interest, or you just get that bad feeling. I mean, take a step back and reevaluate your comfort level in investing. So questions. Katrina, I'll leave it up to you if there are any questions.
Okay. Holly, I'm going to go ahead and stop the recording.